CRMs that I can really tag a few areas and a few things that are important for you, just so you get exactly what matches with your criteria. So sometimes when you're in the process of buying a home, you're like, well, how I'm gonna get the home that I want? But it's actually not that hard. It's quite simple, and I'm here to help you with that. I can set up a few searches. We can talk about it. And once we selected a few homes that you like, what I usually tell my clients is, let's go for a preview of some homes. And that is usually a day that we go and to see between 4 to 6 properties. And on that day, we start collecting some feedback and see if you're liking the properties that you see, or if we have to go to another direction, right? So let's say that you found the property that you like, and you want to put an offer. What do you have to do? So I'll be writing a paperwork for you, and then I'll be doing the negotiation on your behalf. And once the offer is accepted, or if you have any conditions, once the conditions are fulfilled, you have to submit a deposit, and that deposit has to be done in 24 hours. From the time that you do the deposit until the day that you pick up the keys, you don't do almost anything. Your lawyer is gonna do the title search. Your bank is gonna finish running up the fully approval process, and the very last minute is the closing time, when your lawyer is gonna exchange the title with the seller, exchange the money, and you're gonna be picking up the keys pretty much on the same day if nothing goes wrong, right? And that pretty much simplifies the step-to-step home buying process. And yeah, I think it's really important. Some people they like to start with the number 4, like go ahead and preview homes, just thinking like, oh, I think I can afford a $900,000 home, and you can get really frustrated if you really don't know. So I really recommend talking to Simon and understanding what is your budget, understand what's your reality. Sometimes we can help you with a strategy of moving money from one account to another. You can talk to your either financial advisor or what do you call Simon?
Accountant.
Accountant, right?
Yeah.
To help you out with that. And yeah, Simon, why don't you tell us a little bit about the financing part, the pre-approval, or how it works?
Yes, of course. So when it comes to that pre-approval stage, what we want to try and work out is, what is your maximum purchase price going to be? And in fact, what I would rather work out with you is not just what your maximum purchase price is going to be, but what a comfortable price is going to be. Because you can buy the home, but then you want to have comfortable monthly payments after that. You don't want to be stretched every month. So we'll work out what is going to make sense in terms of a mortgage. So in doing that, what we need to do is we need to take into account, what is a bank going to look for when they want to qualify you for a mortgage? And so they're looking for things like, basically, you know what they want to look for? They want to make sure you're going to be able to pay them back the money that they're going to lend you. So they're going to lend you $500,000, $1 million, $100,000, whatever it is. They want to make sure you're going to be able to pay that back. So they're looking for stable, verifiable income. They want to know that you've got good credit. They want to know that you have some savings. Debt to income ratios. This is actually really important. A lot of people make the mistake thinking, I can afford this much in rent, I must be able to get a mortgage that has the same monthly payment. But it's not necessarily the case. It might be, but it's not necessarily the case. There are ratios that come into play where the total that you spend on your household expenses cannot be cannot be over a certain percentage of what you actually make in a given month. And so they want to know about that, and we'll look at that as well. They want to make sure you're buying within a budget, and then they want to make sure that you're buying a marketable property too. If you pay $1 million for a property that's really only worth $600 or $700, they may not actually give you the mortgage for that. And that's where someone like Ian comes in and helps you out to make sure you're getting proper value for the properties you're putting an offer in on. So that's what the lenders are looking for. So what we do in the pre-approval process basically is we start with an application. We have you fill out all your details, all your work history, all your financial details. We need to get your, who you are. And we ask you for documents as well. And documents are everything from your driver's license and your identification documents to T4s, job letters, depending on what your employment situation is, whether you're self-employed or you work for another company. There's different paperwork that may be required to basically verify the income, because that's what we're doing. We're verifying, yes, we've said they have this income and this documentation shows it. We also will do a credit check. Some people get a little worried about the credit check, but it's really not much to be worried about. Hitting your credit will knock a couple of points off it, but it usually recovers in a couple of months, and it's actually really valuable in uncovering issues up front, because the bank will do that check, and if we haven't looked ahead of time and know that everything is good, it can cause issues for you down the road. You can get to the situation where they don't approve you. And what kind of things do we uncover? Sometimes it could be, let's say you had a fight with Best Buy 3 years ago and you forgot all about it, but they put something on your credit. That will turn up. We've had clients who don't have any credit at all. They just never had credit, and so they don't have a credit rating. So we want to make sure, okay, you got a couple of credit cards or something. The banks want to be able to make sure that you have credit and you can manage it responsibly. So we check that. Then we run those calculations. We want to make sure that, okay, you want to buy that $500,000 property. Okay, what is your income and what are your monthly expenses going to be? The general rule is we don't want your household expenses to be any more than 39% of your income. And that's really the max. In certain cases, we can go over, but that's pretty much the max. And ideally, we want to be less than that. And I work through all that with you as well. And then so once we get through all that, I will give you a pre-approval. That's a piece of paper that says, yes, I have worked with Frank, and I can confidently say that he is pre-approved for a purchase of this amount. What I'll also give to you at the end of this process is a spreadsheet. And in that spreadsheet, I'm going to break down all of the numbers for you. So you're going to have how much you need for the actual purchase, based on interest rates, based on whether you need mortgage insurance or not. That's what the purchase is. And then how much you're going to need for your closing costs. And closing costs are also very important. These are costs that are in addition to your mortgage amount. But when you actually purchase the home, you have to pay all these expenses up front. Things like legal fees, taxes, your down payment, of course, and land transfer tax. This is a really big amount, actually. And in Toronto, it's much bigger than if you're outside of Toronto, for example. And for example, if you buy $1 million property in Toronto, the land transfer tax that you have to pay when you close that mortgage is around $30,000. As a first-time homebuyer, you get a rebate, but it's only about $8,000. So you want to know all these numbers, and the spreadsheet I'll give you will break everything down for you. So what you need up front, what your closing costs are going to be, and then even what your monthly costs are going to be once you're in and settled into your home. And, you know, we start with kind of rough numbers, and then as you get closer and closer to finding a place that you want to purchase, we narrow down these numbers so you really know what your costs and expenses are going to be. So
that's great.
Thank you. So once we've got you pre-approved and you're at that stage, I'll actually even talk to you about this up front. There are all these mortgage options. And the big one people talk about is, do you want the fixed rates or the variable rates? And what that means is with a fixed rate mortgage, you sign a mortgage today and it's for 5 years and it's at 5%. It's going to be 5% that whole time. Versus a variable rate where it's based on the Bank of Canada interest rates. You hear their announcements every couple of months. There's one coming next month. And so the Bank of Canada right now is like 3%. Mortgage rates are about 2% above that. And so they move around. So you're not fixed at 5%. It could be 5% and then 4% and then 3%, or it's not going to move that fast, but your actual rate can move around. Typically with variable rates over time, they tend to cost less money, but that moving around can make some people uncomfortable. So we decide what is going to be your best option. And then there's a lot of other things we take into account. Do you need an insured mortgage or an uninsured mortgage? And what that means is if you're putting down less than 20% of the purchase price, you're required to get an insured mortgage. So you actually have to pay mortgage insurance on top of your mortgage amount. It actually mostly gets added into the mortgage, but it's an extra fee that you're going to have to pay. Versus if you put down more than 20%, you don't have to have insurance, typically. And then there's amortization and the mortgage term. So amortization is how long it would take to pay off the mortgage. Let's say you get a $100,000 mortgage. If you were to make all your payments every month, it's going to be paid off in 25 years. That's your amortization period, 25 years. but we don't do a 25-year. Well, we do it in terms of 1 year, 3 year, 5 years. For a long time, 5 years was the most common. We're seeing a lot of 3 years now. And what that means is basically every 3 years, your term expires and you either renew or you refinance at whatever the rates are of that day. So everyone who got a mortgage like 2 or 3 years ago when the rates were really high, they were doing like 2 or 3 year mortgages, knowing that rates are going to come down, and they want to be able to get a new rate as soon as they do. So that's amortization and the term. And then the other thing we look at is prepayments and penalties. Some people want to be able to pay off their mortgage as fast as possible. And so you want to have in your mortgage prepayment options. Not every mortgage lets you pay off extra amounts. So your mortgage amount is $2,000 a month, say. Some mortgages will let you do an extra 10% a year. Others will let you do an extra 20% a year. Some of them will let you do an extra 20% a year, but only once. Others do it only on a monthly basis. So there's all these different options there and how you can actually prepay the mortgage. And then the other side of that is penalties. If you're in a 5-year term, for example, and you decide after 3 years you're going to move or you need to change your mortgage for some reason, the bank's going to charge you a penalty. And the reason they do that is because they were operating under the assumption that they would get a certain amount of interest from you over 5 years. But if you're breaking your mortgage early, they're not going to get that same amount of interest. So they're going to charge you a penalty for that. And the penalty rate, it varies. It changes based on the type of mortgage, what interest rates are doing at the time, and it really can vary. So kind of take all of that into account. But really, if I'm working with you, for example, we sit down and we kind of go through all these options and figure out what's going to make the most sense for you.
Yeah, that's really good piece of information, and everybody is different. I have clients that they want to buy a forever home and stay there, and they don't like the flexibility and the stability of the market, and they just like to go with a 5-year term, fix it. They don't have to worry about anything, and that's just who they are, right? That's the product for them. But I have other clients that they're looking to purchase their first home, do some renovations, maybe in a couple of years sell that home and buy a new one, take the equity out. So the product that Simon is going to tell you which one is the best really depends on what are your goals with the property that you're planning to purchase. And that's a really good conversation, because there's a misconception of thinking that, oh, I just want the lower rate as possible. And sometimes you can get a lower rate, but you have a big term and then you're going to get a penalty. So Simon is really good in narrowing down what is the best product for you. And I really recommend, if you're thinking about getting a mortgage, talking to someone you trust, or possibly Simon.
I like talking to Simon.
Or just talk with Sam.
Okay, next slide.
Yeah.
Okay. Oh yeah. The one thing I forgot too. There's also different mortgage options depending on different life criteria. Certain job categories, for instance, will get different discounts or rates. For example, if you're a first responder or even a teacher, actually, some mortgage companies will give you a little break on the interest rate. If you're self-employed, there's different mortgage options. If you are planning to do renovations, you're going to buy a home and renovate it, there are some different options that might make sense. And things like whether you're a first Canadian, a new Canadian. So there's all these different sort of programs and rates and discounts that potentially could apply. This one's you, Ian.
Yeah, great. So the first part of this slide, it's really understanding what are the upfront costs when you're buying a home, because it's not only the down payment, right? You're buying a 500,000 with the minimum down payment is 25,000, but you have other costs to that transaction, which are the closing costs, right? And they vary between 1.5% to 4% of the home purchase price. What we see more often is that around the 2% mark, and the reason that the closing costs vary is because of the location, how much the city is going to charge you for land transfer. A lawyer might charge a little bit more than another one with legal fees, and you might have home inspection or moving expenses. So it really varies between their range. And the mortgage lender, they're going to want to see that you have the down payment portion, but you also have the closing costs saved up in order to qualify you for a mortgage, right, Simon?
That is correct.
We already spoke about the affordability, so it's important that your income, the housing cost doesn't exceed 39% of your gross income. Um, and there are some other tips that we can give you. I'm not sure if you ever heard about the home buyers plans that allows you to withdraw money from your RSP or the first home savings account as well. So before the RSP account used to be only for retirement, right? So nowadays the government say, well, first time buyers, you have that money saved up, you can actually withdraw up to 60,000 each for the down payment, right? And same thing for the first home savings account. You can put some money there. I believe the maximum amount you can put in there it's 8,000 a year, 7 or 8, and you
Hey,
can withdraw up to 8,000, right?
yeah,
And you can withdraw up to 40,000 tax free as well. And what really happens is you're changing the money from one account to another, and when you file your taxes, you're gonna get a tax deduction and you're going to get some money back that can possibly help you with closing costs or even the down payment, right? For the RSP, you got to be aware of some things like paying back in in the government because they're going to want you to pay back in a spread term.
yeah,
When
you're
it
right.
comes,
Sorry, you're borrowing from your RSP as opposed to withdrawing from. You have to actually put the money back eventually.
yeah, exactly. In the first home savings account, the good thing is that you don't have to give the money back, and it is tax deductible. So this is great if you're a first time buyer and you're planning to purchase a home just to move money to some of these accounts can get you some money back and you can save on your taxes as well. um, Land transfer tax refund, so if you're a first time buyer you're going to get a tax rebate when you're closing, so your land transfer is going to be lower, and that will depend on the city on the purchase price. And there's also a first time buyer credit tax that you can apply to the government. And this is not for all the types of homes. Some homes apply, some others not. That can be up to 1,500 as well. And I think that's pretty much it, right, Simon?
Yeah, I think so. It's the basics. Yes. Yeah. So that was our last slide there. Thank you. Does anyone have any questions that you'd like us to uh, answer?